Assalamualaikum and good morning. My name is Nur Alisanadillah and my matching number is 823824448. Today I'm going to present about my integrated case study based on Swift, Howlish Berhad and Nusfur Berhad. At its core, accounting analysis isn't just about crunching numbers. It's a critical tool for peeling back the layers of a company's corporate reporting. Our primary objective is to evaluate three key areas: financial health, strategy, positioning, and the overall quality of disclosure. By doing this, we have a stakeholder ranging from investor and creditor to regulators to look past the surface and gain a clear understanding of a company's operational risk and future trajectory. Ultimately, we want to see how transparency and accountability lead to more informed, confident economic decision making. To provide a focus step to our study, we have selected risk management as our central theme. We are looking specifically at the how organization identify, assess, monitor, and eventually mitigate potential threats to their success. Our evaluation will measure the effectiveness of a company's response across three main pillars: strategic, operational, and financial risk. In today's volatile market, robust risk management disclosure are more than just a regulatory requirement. They are the primary indicators of a business long-term sustainability, its operational resilience, and its ability to maintain stakeholder confidence even in the face of external challenges. Our analysis is a comparative study focused on two prominent Malaysian public listed companies, Swift Howlish Berhad and Nusfur Berhad, to capture a meaningful view of their financial health and risk evaluation. We examine a 3 years time frame encompassing the financial years 2023 until 2035. All our findings are derived directly from the primary source, the company's official annual reports as published on Bursa Malaysia. This ensures that the data we are discussing is updated, verified, and transparent. In terms of our approach, we didn't just look at the number in isolation. We examined company backgrounds, broader financial performance trends, and crucially, the quality of the specific risk management disclosure. By using a cooperative methodology, we were able to assess how these two entities stack up against one another in terms of transparency and reporting consistency. To make the data easier to interpret, we have supported our findings throughout this presentation with visual tools, including detailed tables, sensor, and comparison metrics. This allows us to see not just what happened, but how the company are positioned relative to each other. To provide the necessary context for our analysis, it is important to understand the fundamental differences between these two organizations. First, let's look at Swift Howlish Berhad. Headquartered in Kelang Selangor, the heart of Malaysian shipping industry, Swift is a specialized powerhouse in transportation and logistics. As the nation's largest haulier, the presence is spread across the industrial and logistics sector nationwide. Their business model is built on high volume integrated service, and they have expanded their operational footprint to support cross-border logistics into Singapore and Thailand, positioning themselves as a regional connectivity leader. On the other side of our comparison is Nusfur Berhad. Based in Johor Bahru, Johor, Nusfur operate within the building, real estate, and machinery related sectors. Unlike Swift's service-oriented logistic model, Nusfur is project-driven. Their market presence is highly localized, with activities centered primarily around major projects in the Johor region and other specific Malaysian development hubs. Their focus is on asset-heavy operations such as machinery trading and on constructions, which carries a different set of financial and operational risk profiles. This contrast is crucial for our risk analysis. So we must manage the risk of fleet maintenance, fuel fluctuation, and regional trade dynamics, whereas Nusfur must navigate the cyclical nature of real estate, from material cost and project-based cash flow visibility. Understanding this core identity allows us to better evaluate the quality of their reporting and the relevance of their risk disclosure. Looking first at their origins, Swift Howlish Berhad started with a clear focus on transportation and industrial support. As they matured, they didn't just stick to the road, they strategically expanded into machinery trading and property-related activity to diversify their revenue stream. Football, however, has a slightly different lineage. They were established in 1989, originally operating as one corporation Berhad. It wasn't until the year 2000 that they underwent a major rebranding to become the Nus Football we recognize today. Both companies have a significant growth milestone by reaching out their their primary industry. For Swift, the focus was on property development and a concentrated effort to revitalize their business operation for the modern market. Swift growth has been notably multifaceted. They successfully moved into a real estate development and investment property, but they also maintain a presence in niche sector like machinery leasing and even landscape maintenance. This broad portfolio suggests a strategy of spreading risk across several different industries. When we look at the current size of these entities, we see two different scales of operation. Swift is characterized as a medium-sized company within the broader logistic landscape, maintaining a diversified by lean operation compared to the global logistic giant. Nusfu operate with a dedicated team of approximately 154 employees. In terms of valuation, they currently hold a market capitalization of roughly 4.86 million ringgit. This figure are viral because this they set the baseline for our financial ratio analysis, showing us the human and capital resources each company has at its disposal to manage the risk we discussed earlier. When we look at Swift Howlish Berhad, the service offering is a strategic mix of heavy lifting and mobility. While they are renowned for their transportation service, they also generate significant value through heavy machinery trading and property development. This combination allows them to act uh, as an to-end partner for industrial client, managing both the infrastructure and the movement of goods. Rosewood Berhad operates a more vertically integrated model within the built environment. Their portfolio spans the entire life cycle of a project, from the commons of building material and the rental of heavy machinery to project management and even final stage landscaping service. This one-stop shop approach for construction and real estate is designed to capture margin and multiple level of development projects. The market positioning of these two companies is further defined by who they are competes against. For Swift, the battlefield is the high-stake logistic and haulage sector. They go head-to-head with major players like Harbour Link Group Berhad, Jing Fan Holding, and Tasco Berhad. Success in this arena depends heavily on operational efficiency, fuel cost management, and fleet utilization. Newsfood, meanwhile, competes in a more fragmented and localized market. The rival include other machinery rental providers and established nation construction firms such as WCT Holding and entity within the Berjaya ecosystem. For Newsfood, the competitive edge comes from project execution and the ability to manage long-term asset depreciation against fluctuation construction demand. Now that we have established the corporate context, let's move into the core of our financial trend interpretation, starting with revenue analysis. Over the 3 year period from 2023 to 2025, we see two very different stories of market demand and strategic execution. First, looking at Swiss Holish Berhad, the company achieved a consistent upward trajectory. Revenue rose steadily from 671.5 million in 2023 to 776.1 million in 2025. This growth is a strong indicator of robust market demand for integrated logistics and suggests that their expansion into a wider transportation network has been highly successful. Their large-scale operations have clearly acted as a positive engine, maintaining business momentum throughout the period. In stark contrast, most football had experienced a steadily decline in top-line performance. Revenue dropped from 159.6 million in 2023 down to 80.5 million by 2035. This represents a nearly 50% reduction, with point towards either significant weaker business demand or deliberate strategic scaling back of their operational activities. These challenges were likely most concentrated in their diversified segments, specifically machinery trading and transportation service. When we step back and look at these figures, strategically the gap is clear. Swift haulage demonstrates superior market competitive and clear path of expansion. Northwood Berhad meanwhile face significant top-line pressure, suggesting they are currently in a more defensive or contracting market position compared to Swift. This revenue divergence set the stage for how we evaluate their respective risk management and long-term sustainability. Looking at Swiss haulage per head, the company managed to stay in the black by maintaining positive net profit across all 3 years. However, the trend is concerning. Net profit decreased significantly from 63.1 million in 2023 down to 28.7 million in 2025. The critical here is that this decline happened even as revenue was rising. This suggests that trade is facing sharp increases in operating costs, likely driven by fuel prices, labor or maintenance, and that competitive pricing pressure in the logistics industry is squeezing their margin thinner. Also, Berhad tells a story of resilience. They started the period with an initial net loss of 2.3 million in 2023. However, they followed this with a successful turnaround, returning to positive profit territory in both 2024 and 2025. While their absolute profit level remains small compared to a giant like Swift, this trend is a strong signal of improved cost management and better operational efficiency during their recovery phase. They are effectively doing more with less. Strategically, this trend highlights two very different corporate focuses. So haulage is clearly prioritizing growth and market share, though they must now find a way to translate that skill into better efficiency. Also, Berhad, by contrast, is focused on recovery and stabilization. Ultimately, this will demonstrate a larger scale of operations and stronger overall profitability, but Newswood has shown commendable financial resilience following its earlier losses. Starting with Swift Polish Berhad, the company consistently maintained exceptionally high gross profit margin, exceeding 28% throughout the entire 3 year period. While we did see a minor dip from 29.5% in 2033 to 28.1% in 2025. The overall performance remains remarkable robust. These high margins are testament to their sustained operational efficiency. It shows that despite the industry-wide cost pressure we noted earlier, Swift still maintain effective control over their direct logistic operation and possesses strong pricing power in the Malaysian market. Looking at Sobahat, we see a very positive upward trend. Their gross profit margin improved from 13.11% in 2023 to 15.51% in 2025. This movement is a strong signal that management has successfully implemented better pricing strategies or significantly improved the management of direct operational costs. However, we must put this perspective. Despite the improvement, this margin remains significantly lower than Swift. This indicates a lower relative operational profitability, likely due to the higher cost nature of the construction and machinery rental business compared to integrated logistics. Strategically, the gap here is telling Swift Polish achieved significantly stronger operational performance and better cost efficiency compared to Misford. Thus, the fact that Swift margin is nearly double than of Misford highlight the vastly different cost structure of their business models. Ultimately, Swift ability to defend such high margins suggests a more robust competitive advantage, while Moscow is showing the right momentum in clawing back efficiency after a difficult start to the period. Swift Howlish Berhad, based in Klang, is specialized in the transportation and logistics sector. Originally established for industry support, it has since diversified into machinery trading and property-related activities. Today, it operates as a medium-sized with a presence primarily across Malaysia. Also, Berhad, headquartered in Johor Bahru, operates in a more fragmented space: building, real estate development, and machinery rental. Its history is one of rebranding. Established in 1989 as Wencom Corporation, it took the Nusfood name in 2000 with 194 employees and a market cap of approximately 4.86 million. It reached its regional and project base. Their service offering reflects their respective sector. Swift focuses on heavy machinery training and integrated logistics, competing with major players like Harbourlink and Tasco. Also provides a one-stop construction model from building material to landscaping, competing against local machinery providers and larger firms like WCT Holdings. When we look at the return on asset ROA, we see a reversal of fortunes. Swift Howlish follow a downward trend, with ROA falling from 3.67% in 2023 to 1.62% in 2025. This suggests that while they are investing heavily in new logistic assets, their profit growth hasn't yet kept pace with the expansion. Muslim, however, achieved a notable turnaround. They moved from negative ROA of negative 0.53% in 2023 to a positive 2.59% in 2025. This indicates a successful recovery phase where they become significantly more efficient at generating earnings from the existing asset base. Based in Kelang, Selangor, Swift Haulage Berhad is a major player in the transportation and logistics sector. Originally established as a transportation and industrial support firm, it has successfully diversified into machinery trading and property-related activities. As a medium-sized company, Swift maintained a significant market presence across Malaysia, supporting the local industry and logistics sector. Its competitive landscape is high-stake, going head-to-head with large entities like Harbourlink Group, Jinhuang Holding, and Tasco Berhad. In contrast, Nusuk Berhad, headquartered in Johor Bahru, operates within the building, real estate, and machinery rental industry. Its history is marked by a major pivot in 2000, rebranding from Wencom Corporation to the current Nusuk Berhad. Nusuk utilized an integrated one-stop model offering everything from building material and project management to landscaping services. With approximately 194 employees and 15 subsidiaries, its market presence is project-based and spread across specific Malaysian regions, competing against local rental providers and larger firms like WCT Holding. When we examine how effectively these companies generate return from their shareholders, we see a stark divergence in momentum. Sri Haulage experienced a steadily downward trend, with ROE falling from 8.97% in 2023 to 3.81% in 2025. This indicates that despite the ongoing business expansion, the increased equity or scale has not yet translated into higher bottom line profitability from the investor. Nusuk Berhad, however, achieved a significant turnaround. They moved from a negative ROE of negative 1.06% in 2023 to a positive 4.40% by 2035. This successful recovery reflects a marked improvement in overall profitability, performance, and financial stability over the 3-year period. Strategically, while Swift Haulage maintained a higher average ROE across the entire period, its momentum is currently declining due to margin compression. Even Nusuk Berhad demonstrate much stronger improvement momentum, actually surpassing Swift Haulage in percentage return on equity by the end of 2025. This contrast highlights the difference between a large company struggling with the cost of expansion and smaller firms successfully navigating recovery phase. Throughout the 3-year period, Swift Haulage Berhad operated on a significantly larger financial scale than Nusuk Berhad. The company maintained total liability that remained relatively high and stable, fluctuating between 991.9 million ringgit and 1,016.7 million ringgit. This reflects a highly capital intensive structure which is necessary to support the extensive logistic infrastructure and large scale operational footprint. Effectively, Swift is utilizing a high leverage model to sustain its position as a market leader in the transportation sector. Transfer overhead presents a very different picture, one of strategic consolidation. Their total assets saw a decline from 441.1 million ringgit in 2023 to 406.5 million ringgit in 2025. Simultaneously, the total liability decreased steadily from 221.7 million ringgit to 167.4 million ringgit. This downward trend across both sides of the balance sheet indicates a successful focus on debt management and deleveraging rather than heavy expansion. Moscow have prioritized strengthening its balance sheet and moving towards more streamlined, less expansion-heavy operations. When comparing the two, the gap in scale immense, with Swift Polish managed an asset base nearly four times the size of Moscow had. While Swift remains in a phase of sustained operational intensity to fuel its logistic network, the reduction in both asset and liability for the Swift suggests that pivoting toward financial stability and risk reduction. One is betting on a scale while the other is betting on a leaner, more resilient financial foundation. Based in Kelang, Selangor, Swift Haulish Berhad is a major force in the transportation and logistics sector. Originally established as a transportation and industrial support company, it has since expanded into machinery trading and property-related activities. As a medium-sized firm with a presence focused on supporting local industrial sector, it faces stiff competition from established players like Harbour Group, Xinhuan Holding, and Gasco Berhad. Its business model revolves around heavy machinery trading, transportation service, and investment activities. Headquartered in Johor Bahru, Nusrat Berhad operates in a more fragmented landscape, including building, real estate development, and machinery rental. The company has a long history, founded in 1989 and rebranding to its current name in 2000. Nusrat utilizes a diversified project-based model spanning building materials, commerce, landscaping service, and investment property. With approximately 194 employees and a market capitalization of roughly 8.86 million ringgit, it competes against local machinery providers and larger firms like WCT Holdings and Kerjaya Prospect. When we look at the debt to equity ratio, we see two very different approaches to capital management. Swift Howlish maintained a relative high leverage with its ratio consistently remaining above 1.30 times over the 3-year period. This high ratio indicates a significant reliance on external financing to sustain its large-scale business operation and expansion. While this leverage support goals, it also reflects a higher level of financial risk compared to its peers. Nusrat Berhad, meanwhile, achieved a significant improvement in its capital structure. Its ratio dropped from 1.01 times in 2023 to 0.70 times in 2025. This declining trend signifies a successful reduction in debt, depends and the creation of a stronger, more conservative equity base. When we look at individual shareholder value through earnings per share, we see a dramatic reversal of fortune over the 3-year period. Self-knowledge experienced a steady downward trend with EPS falling from 7.01 cent in 2023 to 3.02 cent in 2025. This shrinking EPS suggests that shareholder value is being compressed by rising operational costs or growing share base during the expansion phase. Nusrat Berhad meanwhile achieved a massive turnaround. They moved from a negative EPS of negative 2.34 cent in 2023 to a positive 10.56 cent by 2025. This substantial improvement represents a major leap in overall company performance and a strong recovery in shareholder earnings. Moving on to our evaluation of disclosure quality, let's focus specifically on the completeness of disclosure between our two subject companies from 2023 to 2025. During this period, Swift published Berhad demonstrate a significantly higher level of completeness in their risk management disclosure. Instead of just surface level data, they provided detailed explanation regarding their strategic, operational, and financial risks. Crucially, they pair this risk with a clear mitigation strategy and establish governance oversight mechanism. Their report offer robust transparency into the board risk committee, enterprise risk management (ARM) frameworks, day-to-day operational control, and increasingly important sustainability-related risks. Ultimately, this comprehensive disclosure gives stakeholders a highly clear understanding of the company's overall risk exposure and proactive management approach. In stark contrast, Nusful Berhad provided much more limited and less comprehensive explanation regarding their internal control and risk landscapes. Their reporting mainly focused on general operational and financial risks, leaving a noticeable gap when it comes to extensive discussion on risk assessment processes or long-term strategic planning. Next, let's evaluate the transparency level of the disclosure provided by both companies. Transparency isn't just about sharing information, it's about how clearly and deeply a company explains the realities of its operating environment. Once again, Swift College Berhad maintained a higher level of transparency across its annual reports. Rather than providing generic statements, the company clearly mapped out the exact nature of their risk, the potential impact on their business, their underlying governance structure, and specific mitigation strategy. In fact, Swift Knowledge went into great detail regarding highly specific pressure, including logistic operational risk, fuel price volatility, supply chain disruption, financial leverage, and technology integration. What makes their transparency stand out is how they directly link their risk disclosure to their actual operational performance and long-term strategic objective. On the other hand, Nusful Berhad took a much more general approach to disclosing its risk and control measure. While Nusful fully complied with standard reporting requirements, their disclosure lacked depth, containing fewer quantitative details and very limited discussion regarding future risk exposure. Because of this broader, compliance-driven approach, Nusful transparency level is considered moderate. Finally, let's look at the consistency across years for both companies between 2023 and 2025. This metric is crucial because it shows whether a company maintains a reliable year-on-year baseline for investors to track their progress. At a glance, both companies actually maintain relatively consistent risk management disclosure over this 3-year period. The main categories of risk and governance practice continue to be reported annually by both sides. However, Swift Horish Berhad showed a much stronger consistency when it came to their actual disclosure structure, terminology, and level of reporting detail. While they continuously updated their operational risk, sustainability risk, and mitigation strategy to reflect new realities, they kept highly stable reporting format and governance framework. This made it incredibly easy for stakeholders to compare data year over year. Now look at Nusful Berhad. They also successfully maintain their annual disclosure on risk management and internal controls. However, the depth of their reporting varied slightly across the different years. Some sections appear shorter or noticeably less detailed from one annual report to the next, which creates a slight disconnect in reporting continuity. To conclude our evaluation, let's look at the overall trajectory of this disclosure, specifically whether we saw improvement or reduction in disclosure quality from 2023 to 2025. This shows us whether these companies are actively evolving their reporting practice or simply standing still. Starting with Swift Holish Berhad, the company demonstrates a clear trend of continuous improvement. Over the 3-year period, they actively expanded their reporting to include deeper discussion on sustainability risk, operational efficiency, and modern technology-related controls. Notably, Swift Holish successfully integrated ESG and sustainability consideration directly into its core risk management disclosure. This forward-looking integration reflects a highly progressive shift in their corporate reporting practice. Turning to Nusful Berhad, they also show a moderate level of improvement, particularly after recovering from financial losses in 2023. Following that recovery, Nusful later reports provided visibly better explanation regarding their debt management and operational monitoring. However, despite this positive step forward, Nusful overall disclosure depth still lag behind the comprehensive standards set by Swift Haulage. To finish up our analysis of disclosure quality, let's examine the compliance indication for both Nusful Berhad and Swift Haulage Berhad. Let's look at how well both organizations align with strict regulatory frameworks. First, the positive news for both entities. Both Nusful Berhad and Swift Haulage Berhad successfully demonstrate compliance with the reporting requirement of Bursa Malaysia and the Malaysian Code on Corporate Governance or MCCG. Each company properly included formal statement on risk management and internal control within their annual report. However, when we look beneath the surface, we demonstrate much stronger compliance indication. They achieved this by laying out highly formal governance structure and clearly enterprise risk management or ERM framework disclosure. Furthermore, they went the extra mile by providing dedicated stand-alone reporting from their board risk committee alongside extensive governance explanation. In comparison, while Nusful Berhad fully tick the necessary box to comply with governance requirements, they ultimately disclose far fewer details. Their reports lack deep insight into their actual governance, oversight, and practically ERM implementation. Now that we have evaluated the overall quality of the disclosure, let's dive into a specific analysis of individual disclosure items, starting with strategic risk from 2023 to 2025. During this 3-year period, Swift Haulage Berhad provided highly comprehensive disclosure regarding its strategic risks. Rather than offering vague market outlooks, the company specifically detailed risks relating to market competition, logistic demand fluctuation, rising operational costs, and ongoing supply chain disruption. Crucially, Swift Haulage didn't just list these threats, they explicitly explain management's strategy responses and how these factors influence future business planning. This level of detail reflected strong transparency and a robust, forward-looking risk assessment. In comparison, Nusful Berhad also disclosed strategic risk focusing primarily on broader economic uncertainty, lower overall business demand, and general operational challenges. However, Nusful's explanations were noticeably shorter and less detailed. By focusing mainly on macro level general business risks, they omit deeper insight into how the company intends to strategically counter those specific pressures. Next, let's turn our attention to operational risks. Given that both organizations are heavily involved in transportation and logistics related activities, operational risk management is absolutely critical to their day-to-day survival and bottom-line performance. Looking at the data, Swift Haulage Berhad provided highly granular, detailed disclosure in this area. They specifically identify and map out risks involving transportation disruption, fleet management challenges, warehouse operation, fuel price volatility, and overall logistic efficiency. Crucially, Swift Haulage went beyond just identifying these pain points. They actively explain their internal operational monitoring system and their targeted efficiency improvement initiative. They maintain this rigorous disclosure consistently across 2023 to 2025, demonstrating continuous improvement in their actual operational control practice. Meanwhile, Nusful Berhad disclosed operational risk centered around its machinery trading, transportation services, and general business operation. However, their disclosure were framed in much more general manner. Nusful annual reports included significantly fewer details regarding their internal monitoring system or the specific control mechanism they use to mitigate these day-to-day operational vulnerabilities. Let's move on to the next major category of our analysis, financial risk. Managing balance sheet vulnerabilities is key to long-term stability, and most companies address the best by disclosing core financial threats including liquidity risk, credit risk, interest rate risk, and general market risk. When we look at the depth of these reports, we published Berhad provided highly detailed quantitative and qualitative explanation regarding its financial leverage, borrowings, and capital management strategy. Because Swiss College operates with a relatively high debt to equity ratio, the comprehensive disclosure actively reflected a necessary rigorous level of financial monitoring. They gave stakeholders a very transparent look at exactly how they manage their heavier leverage. On the other side, Nusful Berhad also disclosed its financial risk and debt management practice. Interestingly, their reports over this 3-year period tells a positive story of improving financial stability, showing a steady decrease in their liability and debt ratio. However, even with this improving balance sheet fundamental, Nusful actual disclosure remained less comprehensive than Swiss haulage reporting. They simply didn't match the same level of granular detail or deep capital management narrative. Identifying risk is only half the battle. What truly matters to long-term valuation creation is how a company plans to counter them. Let's look at how both companies approach risk mitigation strategy in their annual reports. Sheikh Halish Berhad provided a highly clear and actionable breakdown of its mitigation strategy. Their approach wasn't generic. They outlined specific targeted core action including operational efficiency improvement, technology integration, logistic network expansion, strict cost management initiative, and regular systematic risk monitoring. What makes Swift Haulage reporting stand out is its connectivity. The company consistently links every single identified risk directly to a corresponding mitigation action. This direct mapping gives stakeholders a highly transparent look at a truly proactive risk management approach. Meanwhile, Nusful Berhad also disclosed mitigation strategy in their reports, touching on standard areas like internal monitoring, cost control, and general operational improvement. However, the explanations were relatively brief and lacked granular detail. Because the reporting was kept high level, it didn't fully bridge the gap between what the risks were and how day-to-day operations were actively neutralizing them. To tie all these individual pieces together, let's look at the overarching architecture governing them. The Enterprise Risk Management or ERM framework, a company's ERM framework tells us how deeply risk management is actually woven into its corporate DNA. From 2023 to 2025, Sri College Berhad clearly demonstrated a much stronger, more mature ERM framework. The company didn't just practice risk management as a compliance checklist. They established formal, dedicated governance structure, rigorous board oversight mechanism, and highly systematic risk monitoring processes. Crucially, their annual report indicated that this risk management practice were fully integrated into their strategy and operational decision making. This means risk data actively influence how the business is run from the top down. In contrast, Nusful Berhad disclosed its ERM and internal control system with a more moderate level of detail. While Nusful absolutely complied with basic governance requirements, their disclosure were noticeably less comprehensive and less structured than Swift Knowledge framework. This showed the basic plumbing of risk management but lacked clear evidence of how this system actively impact day-to-day strategic choices. To bring our entire corporate analysis to close, let's look at the discussion and key insight we gather from evaluating both companies between 2023 and 2025. This summary gives us a clear look at the ultimate takeaways. When we pull all the metrics together, Swift College Berhad consistently demonstrates stronger disclosure quality, superior governance transparency, and more robust risk management reporting throughout the entire 3-year period. They set a high benchmark by detailing their strategic, operational, and financial risks right alongside actionable mitigation strategy, and explicit ERM practice. This consistent approach signal a highly mature corporate governance framework, giving stakeholders a very transparent look into how the company protects value. In comparison, Nusfood Berhad chose to provide much less detailed disclosure. However, it's important to note that they still fully complied with core regulatory governance requirements set by Bursa Malaysia and the Malaysia Code on Corporate Governance. When we look at the financial dimension, we see an interesting contrast. So Halage achieved stronger top-line revenue growth during this period. Meanwhile, Nusfood's reports highlighted a positive narrative of internal recovery, showing steady improvement in their profitability, debt management, and overall financial stability over time. To bring our presentation to its final conclusion, let's summarize this ultimate finding of this cooperative evolution between Nusfood Berhad and Sri Halish Berhad. This study looked intensely at financial performance, risk management disclosure, and overall reporting quality across a critical 3-year window. At its core, our analysis centered heavily on the theme of risk management, specifically how both organizations map out their strategic, operational, and financial alongside the actual effectiveness of their enterprise risk management framework. When we look at the governance side, Swift Halish Berhad is the clear standout. They demonstrate stronger overall reporting quality, higher level of governance transparency, and much more comprehensive disclosure regarding operational risk and financial management. By showcasing a highly structured ERM framework, Swift Halish reflected a superior level of governance maturity, which goes a long way in actively enhancing stakeholder confidence. On the other hand, Nusfood Berhad exhibit noticeably weaker disclosure depth and lower transparency throughout the reporting period. However, the financial metric tells a slightly more nuanced story for both parties. Sri Halish Berhad successfully recorded continuous revenue growth and maintained a significant larger operational scale. Yet, despite that strong top-line expansion, they saw a gradual decline on their return on asset (ROA) and return on equity (ROE). This was primarily driven by rising operational costs and intense market competition. Conversely, Nusfood Berhad operates on a much smaller operational footprint, but they achieved a highly significant financial recovery between 2023 and 2025. Following painful losses in 2023, Nusfood successfully bounced back, improving its profitability and reducing debt level to move toward greater overall financial stability. To wrap up our analysis, let's look at the strategic recommendation resulting from this study. We have broken this insight down into two distinct categories: strategic takeaway for internal, external investor, and actionable direction for internal management teams. Starting with the investment landscape, our recommendation depends entirely on investor priority and risk appetite. For investor, prioritizing governance, transparency, and a highly comprehensive structure approach to risk management, Sri Halish Berhad is the preferred choice. Their detailed reporting and mature ERM framework provide deep confidence in their operational sustainability and long-term business strategy. Conversely, Nusfood Berhad presents an incredibly attractive turnaround opportunity for investors focused on financial recovery and rapidly improving balance sheet health. Nusfood's ability to achieve improved profitability and lower leverage by 2025 signal a highly positive shift in financial stability. Now looking internally at what management teams must prioritize moving forward to maximize corporate value. First, there must be a sharp focus on operational efficiency and aggressive cost management to actively reverse the recent decline we've seen in profitability ratio. Second, management should prioritize reducing financial leverage and optimizing asset utilization. This will be key to ensuring long-term financial resilience against market shock. From a reporting standpoint, it is crucial to significantly increase the depth and transparency of corporate disclosure, specifically regarding targeted strategic and operational risks. And finally, by strengthening the public reporting of ERM practice, the company can actively build stronger stakeholder confidence and substantially enhance its corporate governance reputation in the market. Building on our strategic takeaways, let's look closely at our specific recommendation for reporting improvement. This actionable step focus on how both organizations can elevate their corporate disclosure to match international standard. To achieve this higher tier of reporting quality, we recommend four key focus areas. First, maintain multi-year consistency. Most companies need to enhance their reporting quality by ensuring their disclosure structure and terminology remains strictly consistent across multiple financial years. This allows stakeholders to reliably track progress over time. Second, adopt quantitative risk analysis. There needs to be a conscious shift away from purely narrative descriptions toward providing hard quantitative risk data. Additionally, management must integrate technology-related risks directly into their standard risk reporting to reflect modern operational realities. Third, elevate sustainability and ESG metrics. Strengthening this disclosure is no longer optional. Both entities must deepen their ESG reporting to meet rapidly evolving investor expectations and tightening regulatory requirements. And finally, clarify mitigation and oversight. The reports should provide much clearer, more explicit explanation of exactly how risks are being mitigated and how governance oversight is structured. This ensures tighter alignment with the Malaysian Code on Corporate Governance or MCCG. To maintain complete analytical integrity, we must look at the challenges and limitations encountered during this project, alongside the exciting opportunity for future study that these hurdles reveal. Starting with our analytical constraint, we face three primary challenges. First, general disclosure. Several disclosures within the annual report lack detailed quantitative data. This was particularly for Nusfood Berhad. Without hard number, it becomes significantly harder to measure the exact material impact of a certain corporate risk. Second, structure disparity. There is a massive difference in company size and overall business structure between the two entities. Swiss Halush operates on a much larger scale than Nusfood Berhad, which naturally introduces challenges when trying to establish a perfectly level direct comparison. Third, reporting inconsistency. We notice variation in how non-financial information such as future operational risk and strategic planning was disclosed across different years. This variation restricted the year-over-year consistency of our comparative analysis. However, this limitation provides a fantastic roadmap for future research. Moving forward, academic or market study could expand in three key ways. Expanded benchmarking. Future research should look past a simple two-company comparison and incorporate a much wider range of logistic players. This will help build a comprehensive industry-wide benchmark. Deeper ESG analysis, expanding the scope of study directly into environmental, social, and governance or ESG reporting will provide much deeper insight into modern corporate responsibility and sustainable value. Focus on digital transformation. Finally, future analysis could examine digital transformation practice and technology-related risk management. This will be crucial in reflecting the rapidly evolving tech landscape within both the accounting and logistics sectors. We will look at a comparative analysis between Nusfood Berhad and Swiss Halush Berhad. This executive summary provides a high-level overview of our evaluation, which tracks both companies in terms of financial performance and risk management framework from 2023 to 2025. Our core focus during this analysis spanned three vital categories: strategic, operational, and financial risk, as well as how both organizations structure their enterprise risk management practice. When looking at our key findings, a few interesting points immediately stand out for both businesses. Swiss Halush Berhad clearly demonstrates much stronger top-line revenue growth, maintained significantly larger operations, and consistently delivered better disclosure quality. However, they did face a decline in overall profitability, heavily driven by rising operational costs and financial leverage. On the other side of the coin, most food had faced an initial revenue decline but successfully managed to improve its profitability and financial stability following a challenging 2023. While their risk disclosure were noticeably less detailed, their internal governance and active management practice show great improvement over time.